Hey everyone, Clint Lee here, research analyst for the Bauman Letter, and today I'll be bringing you your Friday video. First things first, as always, be sure to check out the links below this video to see how you can get started with the Bauman Letter. So now it's on to business. As Ted told you last week, he's going to be enjoying some well-deserved time off, so I'll be bringing you your video update today. And since Ted's not here, since he's not, on camera to counter anything I'm saying, I figured today I get free reign. Today I can say anything I want, and Ted's not here to stop me. So today the first thing I'm going to start with is to declare that valuations do not matter. All right, valuations don't matter. All right, they do matter. They matter, but based on the time frame that you are incorporating as an investor. And that's what I want to talk about today. I want to talk about the difference between being an investor and using valuations as part of your process versus being a speculator or a trader. Maybe I'll use those terms interchangeably. Because there is a big difference between the two, and depending on which camp you fall in, is very critical to then identifying what factors you want to incorporate and use in your investment approach. And so I thought it would be helpful today to talk about, at least from my viewpoint, the distinction between the two, how I personally approach the two, and the types of things that I'm looking at to be successful there. So let's just start with real quick, throwing out some definitions here. So I would look at an investor as someone who intends to hold a stock or be in the market for at least 12 months, preferably even much longer than that. Versus on the other side, a speculator or trader is someone who has a shorter term time horizon. They intend to hold a stock or be in the markets for definitely less than 12 months. Maybe it's measured in weeks, maybe it's measured in months, but it's a shorter term time horizon. Now, a lot of us are brought up or are taught to take the approach, the mentality of a long-term investor. I know that was definitely the case with a lot of my studies, in undergrad and grad school and my investments coursework. They definitely emphasized investing for the long term. But there's an issue with that. There is a mismatch between being a successful investor and taking that longer term mindset coupled with or against sort of our cognitive biases, the things that pretty much make us human, the fear and greed and the fight and flight response. And so a lot of times, once again, as we're brought up to be investors, and I think about who's the most widely quoted, at least, to be the most successful investor around, that receives the most press, the most attention. It's Warren Buffett. He is a successful long-term investor, and Warren Buffett, he's pretty much short of writing a book and giving a detailed outline step by step on how to do his approach. He's given us a lot of insights into his approach, the books that have influenced his viewpoints. He's packed his annual reports, his annual letters, just full of nuggets of wisdom of how to be a successful investor. Yet there's not a whole bunch of Warren Buffetts walking around, and because of those cognitive biases, it's hard to follow a long-term investing approach. As a long-term investor, you should be scared of this type of a market we're in right now, right? There's a lot of speculative froth, valuations are extended. This is a time when you should be getting out, but that greed instinct starts to take over. You don't want to get out. And then on the flip side, you're supposed to buy, when prices are low, when prices have been beaten up. You're supposed to swoop in and scoop up shares, during times like March of 2009 or March of this year. We had the quickest bear market in history, but how many people are swooping into the market to buy stock, taking that longer term investor mindset. So that's why I say it's hard to replicate. And so I want to talk about some of the factors that influence us as investors versus what we should be looking at using a shorter term mindset first, and then we'll talk about how to incorporate the two. So first, let's just start with being an investor. For being an investor, absolutely, when you're taking that long-term look, valuations do matter. And I have a chart to prove that point. This is something Ted talked about last week, was with CAPE ratios, so cyclically adjusted PE ratios. He's talking about how some people now are starting to incorporate some tweaks to those figures to make it look like the market's not as extended as it is. But let's just take a look at how the CAPE ratio has done at predicting returns historically. And that's the first chart I have for you right here. This is for a time period from 1995 to 2010. And what it does is it plots the CAPE ratio against what the S&P then subsequently did 10 years later on an annualized return basis. So you got the CAPE ratio across the bottom axis here, and then what the subsequent 10-year return of the S&P was on the y-axis on the side. And you can see, I mean, there's a pretty well-defined downslope relationship between the CAPE ratio and what the S&P subsequently does. So, you know, as the CAPE ratio gets higher as you move off to the right-hand side of the chart, that annualized number for the S&P drops. So as CAPE ratios become higher, S&P returns over the next 10 years are worse, and there's a very strong relationship you can see visually in this chart. But once again, that is a 10-year annualized number that we're talking about, 10 years out. So while valuations do work when you're taking that long-term view, they don't work as well when you start to shorten that time horizon, that viewpoint. And I'll show you another chart to illustrate that. So this is a pack of charts similar to what we were just looking at. This plots out the CAPE ratio on the bottom, and then subsequent returns for the S&P 500 on the y-axis on the side. And what this does is this takes CAPE ratios. This actually goes all the way back to 1881, I believe, through 2017. So taking the full historic data set of CAPE ratios and plotting them out against what the S&P subsequently did. Well, panel A is what the S&P did over the next year. And as you can see, I mean, it's complete randomness in panel A. It's noise. There's no real predictive ability in the CAPE ratio to tell you what the stock market is going to do over the next year. There's very little predictiveness there that you can see from this chart. Now, panel B, this is over the next 5 years. And you start to see these dots start to cluster together. Panel C is 10 years. There starts to become an even more well-defined trend. Then panel D is the CAPE ratio and then S&P returns over the next 20 years annualized. So as you keep extending out that time horizon, the CAPE ratio starts to matter very much. But just coming back to my original statement at the start of the video is that valuations don't matter, but they don't matter as much over shorter term time frames. So when you start to get to a year and in, valuations don't really have much of an impact, or at least they don't have a predictive ability to tell you where the stock market's going to go over the shorter term time frames. You know, so if you prefer to look at investing over a shorter term time frame or trading over shorter term time frames, if you've starting to think about this, and I'm not an investor because I don't like riding the ups and downs of the market, I can't handle the volatility, so I want to be shorter term, that's okay. There's no right answer on, you know, should you be an investor or should you be more of a speculator. But it's just that if you are going to be taking that shorter term viewpoint, you need to bring in factors that are different than just looking at valuations. And there's a couple that I would just highlight here right away. And that includes sort of momentum and trend factors, sentiment factors, and breadth factors. So with shorter term type of trend factors, I'll just show a chart of the S&P 500 right here, just to give you an example of what I mean, where you're just trying to gauge the momentum of the market and the potential for mean reversion over shorter term time frames. And there's a couple different ways you can do this. I mean, this is the S&P over the past year, and there's a couple things that you can see in the top panel of this chart. You know, it's at the 50-day moving average, that's the black line, actually did a pretty decent job in terms of identifying what the prevailing trend was going to be in the market. You know, we broke below it, you know, as a signal for getting out the start of the year, you know, as that sell-off set in, and then, you know, as this incredible rally is taking place, we've stayed above the 50-day most of the time pretty much. But then, you know, you can incorporate other types of technical factors. This is the MACD is in the bottom panel here. And all that is really just the difference between two different moving averages. It shows you if the market is starting on a new trend, or if that trend is starting to become too extended, and you could see some mean reversion type of settings. So there's all sorts of different trend momentum type indicators that you can use to help gauge what the market's going to do over a short-term and intermediate-term basis. Same thing with sentiment. You know, I've talked a lot before about CNN's Fear and Greed Index as a way to look at sentiment. It's good at pinpointing tops when there's just too much greed out there, and bottoms when there's just too much fear that's in the market. And it's good at looking at that over these shorter term time frames, but especially when you couple sentiment with breadth. I think that's in my opinion one of the most powerful combinations for looking at markets on a shorter term basis. It's when you see too much greed out there, but then at the same time the participation is starting to dwindle. That's a big warning sign. But then on the other side, there's lots of different types of breadth indicators to use to try to gauge the market's direction. Once again, we're talking about over a near to intermediate term basis. And one example, something I like to use, is the advanced decline volume ratio. And that's the next chart that I have for you that I'll show. This just goes back about 3 months or so on the NYSE's advanced decline volume ratio. So this creates a ratio. It looks at all the volume and all the advancers divided by volume and decliners on the NYSE for any given day. And what you want to look for, I'll give you an example of back in November. We had this this powerful rally coming off the election and vaccine news, and that rally was supported by some very strong readings from this AD ratio. I mean, in some cases, getting up to around 5 or 6 times, the advancing volume relative to declining volume. And what that tells me is that there's a lot of institutional participation in the market when we were seeing that rally. And I mean, small caps, they had their best month, I think, ever in history at that time. So a sign that institutions were becoming active, and that's good news to support the market over, once again, those shorter to more intermediate term trends. So some of the distinctions to make between being an investor versus being a speculator, the types of factors you can use to help make decisions about whether or not to be in the market, to be buying stocks or selling stocks. But here's why I bring this all up. It is to align your approach with the factors that matter. Once again, being an investor versus being shorter term, there's no right answer. But what I think is key is to understand your own risk tolerance, how you like to view the world, which approach is going to work best for you, and then start to build your discipline around that. Because if it's a discipline and an approach that you can stick to, that's ultimately where you're going to find success. That's where you're going to be the most successful. It's not saying, I want to be an investor because that's what everyone else tells me to do, but then you can't stick to it. You make the wrong decisions at the wrong time, and that costs you money. So maybe during the holidays, as times maybe starting to get a little bit quieter, things are winding down, you can go through a period of introspection and figure out where your viewpoints tend to reside more on the longer term side versus the shorter term side, and then looking at your approach and if it really does a good job at reflecting that. Now, for me personally, I like to incorporate both approaches into my own investment portfolio. So in my retirement money in my IRA, I tend to take more of the investor viewpoint. Valuations matter very much about the types of stocks that I hold in my retirement portfolio. I'm taking a long-term horizon. They tend to be more value-oriented and a lot of times in cyclical industries, but then also the safer, more stable dividend payers, dividend growers that I hold in there as well, versus in another brokerage account where I'm definitely more the speculator. I take a shorter term look at the market. I use a lot of momentum and breakout patterns and identifying the stocks that I want to be in. Valuations don't really come into play much at all in that portfolio. And then I'm using these things like sentiment and breadth to try to gauge the near to intermediate term trend within the stock market overall. And I think by combining them, there's a diversification benefit. Just like you don't want to hold one stock, you diversify across stocks. I look at it as diversifying across these different approaches, because really one's kind of a value approach and one's a momentum approach. And from a factor standpoint, those are negatively correlated strategies, and so there should be a diversification benefit there. And it's also the approach that we take in the Bauman letter to an extent. So when you look at the Bauman letter, if you're a Bauman letter subscriber and you look at our model portfolio, we have different categories of stocks in there, we have one category that's safer, more stable dividend payers. We have stocks that are low valuation, extremely cheap, in playing in cyclical sectors. And then we also have more speculative, higher growth stocks in the portfolio as well. So, and to that extent, we are showing you, we're helping to guide you along the way in terms of the types of stocks that you could look at, whether you want to take that investor or speculator viewpoint, or how you have that menu then to select from to combine those positions to however you see fit to once again sort of satisfy your viewpoints or your risk tolerance in terms of how you're looking at the markets. And then from there we have also other more speculative stock trading services with Profit Switch. And then I'm also going to have my own option strategy service that'll be launching here right at the start of the new year. So just in about a month or so, be on the lookout for some updates on that new service, that option service, once again, playing more into sort of that speculative side of the markets. Well, that is all I have for you today. This is Clint Lee for the Bauman Letter. Thanks for watching.